Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland here with John Paul Hampstead as usual. JP.
Yep. Hey,
how's it going?
Thanks for having me. Why did I say that? I'm on the show every week.
Every week.
But Merry Christmas.
Merry Christmas, Happy New Year.
We had our
Hanukkah.
Christmas party last night. That was fun.
We made it.
A lot of really ugly sweaters. We're still here this morning though, so
yeah,
that's cool. I don't know, let's talk about markets, get into it.
Yeah, so it's been a pretty good peak season so far, especially on the retail side.
Right.
You know, some of the things we've been watching across the country, the Midwest has finally picked back up. The Southeast has started to pick, I mean, really just tightness everywhere. It's pretty pervasive, except for a few small markets across the country. But what are you hearing right now? I know we were talking about Minneapolis the other day, seeing some of the highest rates ever.
Yeah, I mean, just talking to brokers paying, upwards of $5,000 to $6,000 to move loads from Minnesota and Wisconsin to the East Coast and down into sort of northern Florida. Super expensive. I heard it from a Chicago-based broker too that the sort of the AORBD ELD mandate, that change has actually really impacted team capacity. Because now you no longer have like the faked like husband and wife teams. You no longer have like the hard solos, and the team true team capacity has gotten really tight and made those cross country runs super expensive.
Wow.
But I agree with you, Zach, that overall what we're seeing is a pretty nice retail pop. Nothing crazy, nothing special, but it delivered.
Right. Yeah, outbound tender rejection.
Santa's coming.
Yeah. Outbound tender rejection rates are as high as they've been since January 6th, I believe. So we're bumped over 11% for the first time since that point in time. So, I mean, that's a pretty good signal. Speaking of Minnesota, I watched those rejection rates just go off the charts here this week.
Yeah,
I mean, it blew up.
Especially for refrigerator equipment. I think in the upper Midwest and really down through like Missouri, it's just
reefer demand actually spiked in Florida. Oh,
really?
Yeah, maybe some early season. The produce comes out of Florida this time of year as well. I mean, they have a late extended season, so we saw some reefer demand spikes there coming out of Florida this week.
That's interesting. What about rates?
So they're all high.
Yeah. Are they like getting sort of? Is it sort of like anything goes? Are we getting that crazy, or are brokers like keeping a handle on the market?
So it's pretty much like free for all at this point. I think everybody's pretty much realized that the supply conditions are way down. Volumes actually are not driving it, but they are elevated year over year. Everybody talks about this 2018 being this big, massive, robust year, and we're killing 2018 right now. You saw the tender volume index 8% up year over year. So
that was what actually surprised me about this holiday season, is that going into it, we were telling people, hey, if there is going to be tightness, it's going to be on the supply side, not because of anomalous demand.
Right.
Yet, unlike 2018, which saw sort of steady deterioration in national volumes through the month of December, they've gone down this December, but not harshly.
Yeah, last year,
not sharply.
Yeah, I think one of the things to note is last year we were in the middle of the free fall throughout retail last year. Right. I mean, volumes declined rapidly after Thanksgiving. I mean, capacity didn't necessarily just disappear, but we talked about it last week where the conditions were such that we had some time where the tender rejections and the capacity kind of softened for about a week or two prior to ramping back up. This year we didn't have that.
Right, and so part of the reason the market's been tight is it's both sides really. It's demand and supply, which is interesting. And I guess my question for you, Zach, is how persistent and permanent do you think supply side tightness, capacity tightness is right now? I mean, is it about weather? Is it about home time? Is it about people not wanting to drive during the holidays because the rates aren't high enough? Or are we seeing is the capacity cycle turning?
I think it is turning, but it's not going to be turning to the extent that January we're going to see like we saw in early 2018. I think we're seeing this big smile.
Right. You're right.
in
2018 January
Yeah.
was anomalous.
Yes.
It was like hot.
Yeah.
It was like a white hot January.
Yeah, I think winter is here.
Yeah.
It's coming. What is it, in a day or so?
Winter? It's here, dude.
It's here. So the winter season
There's
for all.
frost on my windshield.
So January is still going to be January.
Right.
And I think this January is actually going to be pretty rough.
So it's not going to be different this time?
No, I don't think. I don't think people are going to expect to see June volumes in January for some reason.
Right. Okay.
I think this has been a really good peak, really good.
Given like how bad the summer was.
Yeah.
The peak this year is really good, but Q1, I mean, it's not.
It's still Q1.
The reason, and if you talk again, I think I said this last week, but if you talk to Henry buyers, there are reasons to be fairly bearish on Q1.
Yeah.
Just with all the freight that's already in the country, and a much slower economy than Q1 2018, things like that. Like, and I guess the main question is just the truck drivers, the capacity, and what role that plays. And that's one of the hardest parts of the equation to measure.
Yeah, and the supply side conditions in the long run look to be a little, they're bearish throughout the first half of the year, but I think we're going to start to see, especially with the ELD, AORBD, increasing barriers to entry, the drug alcohol clearinghouse, all of these things are going to come together. But mainly increasing costs are going to keep people from entering the market as readily as they were before. And that's going to show up in this next 3 to 6 months, I think gradually at first. And then by the second half of the year, we could potentially see another 2017-ish type scenario.
Right. What are the things we should be looking for in the first quarter that would tell us sort of directionally where the market's going?
So you really need to see how the volumes are performing year over year. You can ignore January this year. We're going to have a double hit in terms of Christmas on Wednesday, New Year's Eve on Wednesday. That's going to create this 2-week lull with shippers. I mean, it's going to take them time. I watch it every year, especially with the timing of the holidays. Like when the New Year's or Christmas holidays are earlier in the week or later in the week, it doesn't have as big of an impact, but this one will have, it's like taking a 2-week vacation.
Right.
So we're not going to see these volumes ramp up rapidly at all.
People have seasonal affective disorder. They kind of, frankly, get lazy around the holidays.
Yep.
They don't want to work as much, and they're taking time off anyway. And so they get back, and whether you're a transportation manager or a dispatcher or whatever it is, it's you don't put as much freight out.
No.
And you spend more time. You say things like, "Oh, we're getting situated again."
Yep.
Which basically means, we're not working.
Yeah. I mean, and a lot of the stuff that's moving now is retail.
Right.
A lot of the stuff that moves in January is industrial. And we're basically in an industrial recession right now.
Right.
It's slumping pretty dramatically. Listening to Anthony Smith talk about this, industrial production growth is down negative for the last 6 months.
And what I worry about too is entering into, depending on kind of where you fall on the political spectrum or not, frankly, entering into an election year isn't, especially with the current political dynamics, isn't really the best setup for an industrial recovery. It's not like
Right.
It's not like people who were cautious in 2018 because of trade policy uncertainty.
Right.
They're not suddenly going to get super confident in 2020. If we've got for example, Trump versus Sanders or something like that, right?
Yeah, no, they're going to be a little bit more hesitant to invest and get that going. So it's especially considering there's a lot of political unrest at the top there. So they're not going to necessarily be willing to invest in new facilities, new production, capital goods expenditures.
The only
are going
thing,
to be down.
if we can keep the positive momentum going on trade, that might spark some kind of CEO confidence. Other than that, though,
Yeah.
it's hard to if you look at all of the list of things that could make January or the first quarter better than expected. It's not. There's not a lot.
There's not a lot there.
list.
So we'll have to wait and see on the recovery side, but supply side dynamics should be pretty constrictive here in the next couple of months. So it'll be an interesting summer, if you will. Well, that'll about do it for this week's On the Spot. So make sure to check us out on all our social media. Check out our FreightWaves Live app if you haven't already. And everybody have a great, safe holiday. And we'll see you in a couple of weeks.
In May of 2020, FreightWaves Live is headed back to the largest freight market in the Southeast, Atlanta, Georgia. Join FreightWaves for our best event yet, featuring captivating keynote speakers and rapid-fire demos of technology that is sure to take our industry to the next level. This is your opportunity to interact with some of the most innovative leaders as we mark a new decade in transportation. See you in Atlanta May 5th and 6th.